Phil, I'll start with you. Just taking a look at the market, the S&P specifically, the fact that we've been pretty range bound, not only today, but in recent trading sessions after we quickly saw it retrace 50% of its decline. Where do you see it going from here, and what do you see as the biggest potential catalysts? Is it still medical headlines like the ones we just got a moment ago from Sue Herrera, or are there other pieces, other factors that are going to continue to drive the market action?
Yeah, Morgan, good morning. Greetings from the great state of New Jersey. So, when we, as asset allocators, we made a very, very sharp move by taking our equity allocation in our multi-asset portfolios down by about 20% by mid-March. That was a very bearish stance. At this point, though, Morgan, we're not leaning nearly as bearish as we were back then. And I think that while still underweight, we've replaced almost 50% of that risk. And, I think it's driven by the confidence around policy. We've spoken a lot about it. The Fed stopped LIBOR from increasing. Corporate debt is starting to act really well as a good diversifier. Congress has responded much, much more than what people were expecting through small business loans and unemployment insurance. And I think that's what's being digested by the markets through what you were just talking about in terms of being range bound. That, the question now remains, what is the right multiple for the market given this extraordinary policy response, right? And we are assuming in our base case that Q2 will mark the low point in economic activity in this crisis. And I think that's why you shouldn't really lean as bearish. And we're taking our cues really now in this kind of final part of the staggered reopening of the economy. And I'll also remind you with the stock market, there is a historically compelling dividend yield versus where fixed income is right now. Treasury rates so low, that worked in a major way in the last cycle. And I think we're going to continue to point to a tailwind on stocks being so compelling versus debt. And the last thing I'll say is just as asset allocators, we need to think about the right defense. And that's both government bonds and investment grade credit right now. Investment grade credit is yielding 2 to 3% over treasuries right now.
Yeah. So just to follow up on that, what is the right multiple for the market right now? Where do you put it?
Yeah, so we're doing the same calculation everybody's doing. If you see a material reduction in earnings, that's worse off than where we were in the beginning of the year. But what we are getting, okay, is the Fed is basically buying anything that's not nailed down. If the Fed walks into your store, prices are going to go up. So, I think that the average multiple of 16 times that we've seen over multiple decades is probably too low in this environment, even with the material reduction in earnings and growth. I think the market is kind of looking through that. They're expecting that. That's why we had the policy response. And I think the multiple should be higher than long-term average in the near term, given this just extraordinary historical wartime spending from Congress and the Fed really buying everything that they possibly can to stabilize capital markets.
Morning, Chetan. I want to go back to this headline that we just got on hydroxychloroquine, and because it's something that the president had touted as a game changer, and now the scientific studies are showing that the primary outcome from taking it can be negative outcome, can be death. Do you expect any market reaction from that, or are we mostly looking at things like the amount of testing that's available, whether it is virus testing, antibody testing, and the ability to get back to the economy opening up in various states?
Yeah, I think the market is probably going to be focusing more on the staggered opening that we were discussing earlier on. So that's basically watching, how the states are beginning to reopening. I think the rule book right now for the market is still to look at what had happened in China. So once the number of new cases peaked out in a few weeks, you started to see actions being taken to reopen. In White House's guidelines, if you take that into consideration, 14 days after the new cases peak and they are declining, you will see opening of several states. And so we are actually looking at 28 days, not 14 days, because the phase one is not so meaningful opening. But in 28 days, we would probably, if you take the data on the new cases peaking out, by middle of May, you would have about 48% of GDP, the states which are accounting for 48% of GDP, we'll begin to see meaningful opening if we take that guideline as well as the data on new cases into consideration. So I think the market is probably going to be more focused on that. And if there's anything that indicates that new cases are not peaking quickly or not rolling down, that will be a bigger factor weighing on markets' mind than the news flow on therapeutic drugs.
So, Chetan, just to dig into that a little bit more, I know one of the things you've written about recently is reopening in China and what economic activity has been looking like there. How much of what we've seen take place in that country can actually be applied to the U.S. and also parts of Europe where we are starting to see these reopening plans emerge? So
we are seeing a lot of similarity, actually. The only difference is that the scope of the outbreak in Europe and in the U.S. has been much bigger. So we are kind of observing that all the activities in terms of reopening, et cetera, is lagging China by about 3 months. That is that China started to see the outbreak a bit earlier, and then U.S. and Europe has had a wider scope of the outbreak. There is a lot of similarity and things which we are learning, and we are seeing something similar going on in Europe. So we think the global economy is going through a rolling bottom. China's data bottomed in Feb. Europe is bottoming in April, and the U.S. will also bottom in second half of April. And then we are going to see opening of most of the places or several of the parts of U.S. and Europe in the month of May. So the economic data will be recovering from month of May for U.S. and Europe. So it's pretty much following the China track with a different level of lag because of the scope of the outbreak.